Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is the overhaul of regulatory capital requirements proposed by U.S. banking regulators. My name is Jeff Taft, and I'm a partner in Mayor Brown's Financial Services Regulatory and Enforcement Practice in the Washington, D.C. office. Joining me today is Mayor Brown partner Matthew Bisanz. Matt is also a partner in Mayor Brown's Financial Services Regulatory and Enforcement Group in our D.C. office. In our 30 minutes today, we are going to provide a high-level overview of the key areas of the capital proposal issued by the U.S. banking regulators on Thursday, July 27th, and briefly discuss the proposed changes to the method for calculating the capital for global systemically important banking organizations, otherwise known as GSIBs, in the Fed's GSIB proposal, which was also issued on July 27th. At the risk of spoiling the surprise for those who have not yet opened the capital proposal, it's over 1,000 pages and addresses nearly every section of the existing regulatory capital requirements. The good news is that the comments on the capital proposal and the GSIB surcharge proposal are not due until November 30th, 2023, so you still have plenty of time to include this in your summer reading and still comment on the proposal. With that, I will start us off today by providing some background information on the capital proposal and the banking organizations covered by it, and then discuss the regulatory capital calculations in general. As many listeners know, the U.S. regulatory capital requirements are broadly derived from the regulatory capital standards maintained by the Basel Committee on Banking Supervision. While the Basel Committee publishes the general requirements, it's up to the various countries to implement. Countries may deviate from the standards and may impose more significant requirements. In 2017, the Basel Committee finalized revisions to its capital standards in a consultation process that the industry refers to as Basel IV or the Basel Endgame. The stated goal of the Basel Endgame was to reduce excessive variability of capital requirements across banking organizations, while not significantly increasing capital requirements for these institutions. The revisions were extensive, and the Basel Committee intended for national governments to implement most of the Endgame proposal by January 1st, 2022. That deadline was ultimately pushed back to January 1st, 2023 due to the COVID pandemic. While the capital proposal does not directly increase the capital requirements, it generally would result in an overall increase in the amount of capital banking organizations must hold by changing the ways in which certain capital, asset amounts, and exposures are calculated. Additionally, it will apply new capital requirements to certain banking organizations, which clearly will result in an increase in the overall capital requirements for those organizations. The capital proposal would revise the regulatory capital requirements for U.S. banking organizations with significant trading activities or total consolidated assets of $100 billion or more. U.S. banking organizations would include national banks, state member banks, non-member banks, federal and state savings associations, top-tier bank and savings and loan holding companies domiciled in the U.S., and U.S. intermediate holding companies for foreign banking organizations. They generally would not apply directly to U.S. branches or agencies of foreign banks or the non-U.S. operations of foreign banking organizations. Specifically, the capital proposal would apply to any banking organization with $100 billion or more in assets, as well as others with significant trading activity, and would significantly increase the capital requirements for most institutions. This would require the 8 U.S. GSIBs, approximately 22 larger and mid-sized U.S. bank holding companies, 10 to 12 U.S. intermediate holding companies of foreign banking organizations, and 7 to 10 other banking organizations to comply. It would again not directly affect credit unions, U.S. branches and agencies of foreign banking organizations, or the non-U.S. operations of foreign banking organizations. Banking organizations with less than 100 billion in total consolidated assets would remain subject to the existing standardized approach and leverage ratio requirement, community bank leverage ratio framework, or small bank holding company policy statement. The capital proposal would generally collapse the categories 2, 3, and 4 banks into a single bucket for purposes of applying these requirements. Effectively, this reverses many of the capital-related aspects of the Federal Reserve's 2019 tailoring initiative for larger regional banking organizations, which implemented the Regulatory Relief Act in 2017. While this primarily would affect top-tier U.S. banking organizations, it would have a particularly negative impact on certain foreign banking organizations that sought to reduce their U.S. footprint in response to earlier regulatory initiatives. Also, as somebody who's spent the past 25 years in Washington, I'd be remiss if I didn't mention the politics related to the capital proposal. In the lead up to the release of the capital proposal, there have been numerous speeches by federal agency staff and letters from Capitol Hill directing the agencies regarding this proposal. The release of the capital proposal was marked by significant dissents by principals at the FDIC and the Federal Reserve. In particular, at the FDIC, Vice Chairman Travis Hill and board member Jonathan McNernan voted against issuing the capital proposal and issued strong statements sharply criticizing the proposal, particularly the deviations from the Basel Capital Committee endgame standard. Similarly, the Federal Reserve governors Michelle Bowman and Christopher Waller voted against issuing the capital proposal and raised concerns about the potential impact of the proposal on the general economy. Although Federal Reserve Chair Jay Powell and Governor Philip Jefferson voted to issue the capital proposal, each made statements indicating concerns about its potential effect and signaled that they would be looking to make changes to the capital proposal. The capital proposal will undoubtedly be subject to ongoing debate in Washington over the next few months, and we expect the banking trade associations and many of the affected institutions to prepare comment letters. With this background, let me transition to regulatory capital calculations. As many of you know, banking organizations calculate the amount of regulatory capital they hold by aggregating the adjusted accounting values of eligible capital instruments such as common stock, retained earnings, and certain types of preferred shares. The capital proposal would generally not change the eligibility criteria for regulatory capital instruments or the regulatory adjustments and deductions to such instruments. However, there are some additional disclosure requirements and certain changes in the proposal that will likely result in a number of banks needing to hold some additional capital. First, while it does not change the eligibility criteria for Tier 1 and Tier 2 capital instruments, it would require certain new disclosures. In particular, it would require Category 3 and Category 4 banking organizations to disclose to holders of new Tier 1 and new Tier 2 capital instruments that they may be fully subordinated to interests held by the U.S. government if the banking organization enters into receivership, insolvency, liquidation, or a similar proceeding. Second, and certainly more significantly, the proposal will require all banking organizations with 100 billion or more in total assets to account for unrealized losses and gains in their available for sale securities when calculating regulatory capital. The change would effectively undo the long-standing option for banking organizations that are not subject to the advanced approaches, generally the Category 3 and 4 organizations, to opt out of the requirement to include in Common Equity Tier 1 capital all components of their AOC, with the exception of net gains and losses on cash flow hedges related to items that are not fair valued on their balance sheet. This could have a significant impact on certain banking organizations. According to publicly available data for some banking organizations, AOC may constitute as much as 70% of their Tier 1 capital, with the average across effective banking institutions being in excess of 18%. As discussed later, this requirement would be phased in over several years. Nevertheless, these institutions would likely need to raise capital to account for the inclusion of the AOC. Finally, all banking organizations with 100 billion or more in total assets would be required to apply the capital and total loss absorbing capacity holding deductions and minority interest treatments that are currently applicable to Category 1 and Category 2 banking organizations. With that general information, let me pass the microphone over to Matt, who's going to discuss the credit risk, market risk, and operational risk capital requirements in the capital proposal. Matt?
Thank you, Jeff. I think one thing that's important to remember is what Jeff said, that this really affects the 50 or so largest banking organizations in the US. And each of those 50 banks has their own risk profile and also their own business profile. And so while for some banks, the AOCI charge that Jeff just talked about will be one of the more significant issues, for others, we're looking at different risk stripes. And I'm going to take us on a blow-by-blow through the different risk stripes and start off with the granddaddy of them all, credit risk. That credit risk is the risk of a borrower or counterparty not paying. And historically, it's been the largest risk that a banking organization has faced. And so the capital standards for this are the most sophisticated. They're the longest standing under Basel going back to 1989. And the proposal would make some changes, but this is not where the focus of the proposal is. That under the credit risk capital requirements, we would get rid of the advanced approaches that I think most people saw was coming, that internal models have been on the downswing for a while, and so advanced approaches for credit risk are gone. We would see more granular risk weights for real estate-based loans, that there would be an incorporation of the loan-to-value ratio on a dynamic basis, as well as the cash flow dependence of the real estate asset when calculating both residential and commercial real estate exposure risk weights. There would be new risk weight sets for retail, subordinated debt, specialized lending, and acquisition, development, and construction exposures. The retail exposure in particular probably will be of interest to credit card banks, specialized lending, maybe for some project finance focused lenders, but again, a lot of these are tweaks at the edges. There would be adjustments to the way equity investments are treated, but again, not the biggest, because there aren't banks that have a terribly large number of equity investments, though maybe some for foreign banks that are doing it through their IHC. And then also an adjustment in the way that credit is held for undrawn lines of credit. So the undrawn portion of a credit card or a liquidity facility, that would have a slightly more punitive risk weighting that will be a significant issue for credit card focused banks. But again, that isn't the focus of this. And so moving forward to the leverage ratio framework, that is a version of the credit risk that looks at the entire balance sheet. And here the big change would be the supplementary leverage ratio would be extended to all banking organizations with 100 billion or more in total assets. So this would extend it to all of category 4 and much more of category 3 than it previously applied to. It also would require all 50 of these banking organizations to use the standardized approach to counterparty credit risk to calculate their derivatives exposure, which may push up the total amount of assets that are being included in the leverage ratio. So we may see some pain for significant smaller for banks that are smaller but have a significant derivatives portfolio, because that will be penalized under the expanded supplementary leverage ratio requirement. Continuing to move down the capital stack, we have the CVA risk capital requirements. This is something that, again, is an esoteric part, but it is an important one, because this is the capital charge resulting from changes in the value of derivatives transactions. So not the likelihood of a counterparty default, but more like a market risk on counterparty exposure for derivatives. Historically, this was embedded in the credit risk rules. It is now being extracted and put in as a standalone capital charge. There would be standardized approaches that would be used. You could pick between two depending on the level of quantification that you're capable of doing. You would need to have identification, documentation, and operational controls to identify when the banking organization is facing a risk of change in value of the derivative. And these charges would be part of the capital stack that would be under the new expanded approach. So it would be, again, for all 50 banking organizations. All of what we've been talking about so far have been on the credit risk side. The other area, and this is changing more significantly, is market risk. And so market risk is generally the change in value of an asset based on things like interest rates, inflation, not things based on the default of the borrower. Historically, these capital requirements applied only to banks with with $1 billion or more in market risk assets and liabilities, or that had 10% or more of total assets in market risk activities. The good news is that first threshold is being increased from 1 billion to 5 billion in recognition that since 1996 we have had some inflation. However, the rest of the market risk provisions are less favorable. Among other things, model usage will be greatly constrained. There will be modeling done at the individual trading desk level for market risk, and so there will be less opportunity to either offset or mitigate exposures across an organization, because you'll be calculating capital on a desk by desk basis. And also, this whole increase will not take into account the global market shock component of the Federal Reserve's stress capital buffer requirement. And so if you think about it, the market risk capital requirements are really a tail risk of how might a bank lose money because of extreme variations in the value of its investments, its derivatives, its equity holdings, which kind of sounds like a capital stress testing, but it's on an ongoing basis. And so there is a fair level of duplication between capital stress testing and regulatory capital requirements. The proposal does not address this duplication. The other part of the market risk rule that will affect a lot of banks, even some of those outside of these 50 largest, is the redefinition of the trading book boundary. And so all of the bank's assets are assigned either to its banking book or its trading book. Banking book is what we think of as traditional loans, long-term investment activity, other types of credit-heavy exposures where the main risk the bank is exposed to is the default of its counterparty. Trading book is where the bank has exposure to market risk. And historically, the bank was allowed a fair degree of flexibility, that there were eligibility requirements for what could go in the trading book, but the rules were not as well defined. The proposal would subject the banks to more comprehensive mandatory assignment rules of when something must go in the trading book and when it may not go in the trading book. And it would reduce the ability to have it, pretty much eliminate the ability to have capital savings from switching between books. This is, again, intended to make market risk a more stringent regime, and it will affect smaller banks because they will have to go back and look at all of their banking book exposures to make sure that none must be moved into the trading book, and therefore push them over the 10 or 5 billion thresholds. The other area that I want to cover briefly is around operational capital risk requirements. And I think this one is the one that banking organizations have the least familiarity with. That operational risk is the risk of loss resulting from inadequate or failed processes or events. And the great example I like to use here is if a bank gets hacked and loses money because it's hacked, that is an operational risk. That isn't the failure of a counterparty, that isn't a change in interest rates or market prices, that is an external event, or in some cases, to say an insider fraud that has happened to the bank. And so operational risk is a huge, lumpy portfolio of risks, because it ranges from everything from the bank getting robbed in an old Western movie style all the way to, like I said, cyber attacks. Historically, only advanced approaches banks were required to calculate an operational risk capital charge, so only the 10 or 12 largest US banks. And then they were allowed to do it using internal estimates. regulators have been concerned that this is an insufficiently small portfolio of banks to calculate an operational risk capital charge, and also that internal models are as the regulators have viewed, bad. So the proposal would expand the operational risk capital charge to all 50 of these largest banks, and it also would require them to use a standardized approach. This standardized approach would be based in small part on interest revenue and in large part on fee-based income. So banks with significant fee-based incomes, think fiduciary fees, custody fees, asset servicing or loan servicing fees, credit card fees, like annual fees for credit cards, interchange, banks that derive a significant portion from annuities for banks that are significantly in the insurance industry, other types of insurance sales by banks, all of those fees would have a very significant role in calculating the operational risk capital charge. And finally, the operational risk capital charge would be driven by what's called an internal loss modifier, which is how a bank's own historical losses compare to other banks out there. And this is where the US has increased its capital requirements versus Basel, like Jeff was saying at the beginning of this program. And this is one area, again, where the US regulators are being fairly punitive in saying that you can't have a lower loss modifier than your peers, so it's floored at 1, but you certainly can have a higher loss modifier than your peers, and it can go up from 1. And so it's saying there is no such thing as a bank that is good at managing operational risk, or a bank that has below average operational risk, that you are either average or worse than average at managing operational risk. For some banks, the operational risk capital charges will be significant, well over 20% of what currently is in the credit risk charges. And we expect this will be, again, a sad response for banks that for years have been told, well, try to get more fee-based income because it is steadier, safer, it's not prone to as much market volatility. And now these banks are being penalized for having sought out that safer fee income. It also is a fairly lumpy approach because it applies the same risk charges regardless of the type of fee income. And so you may have fairly safe fee income from things like safe deposit boxes, credit card annual fees, and that is being assigned the same type of capital charge as a much riskier activity, much more variable, not even riskier, a much more variable activity like related to interchanges for credit cards, or related to aspects of trading activities for securitization portfolios, or loan servicing portfolios, some things related to insurance sales. So really not a good granular approach to distinguishing among operational risks. But I've gone on enough about the capital stack. Jeff, maybe can you take us back to some of the things away from the risk stripes?
Thanks, Matt. Yeah, let me kind of cover off, I guess, on long-term debt, maybe the GSIB surcharge, and then some of the transition timeframes. As many of you know, only U.S. GSIBs and U.S. intermediate holding companies that are controlled by global, systemically important foreign banking organizations are required to maintain an amount of outstanding eligible external long-term debt. For U.S. GSIBs, the eligible long-term debt requirement is the greater of a percentage of the organization's risk-weighted assets and total leverage exposure. In the recent months, U.S. regulators have suggested applying the eligible long-term debt requirements to banking organizations with more than $500 billion in total assets. The capital proposal does not contain an eligible long-term debt requirement, but we expect that the U.S. regulators will release a further proposal in the next few months that'll address this topic and will likely apply this requirement more broadly. Moving on to the GSIB surcharge framework proposal. As noted at the outset, in addition to the capital proposal, the Federal Reserve issued the GSIB surcharge proposal. This proposal would not change the GSIB surcharge framework, so there's no adjustment in the way that GSIB surcharge applies. It also would not incorporate the Basel Committee framework for crypto assets, exposures, or the Basel Committee guidance on applying capital requirements to climate-related financial risks. However, it would make certain technical changes to the GSIB surcharge. Most significantly, it would make the changes to the measurement of some systemic indicators, including revising the systemic indicators for cross-jurisdictional claims and cross-jurisdictional liabilities to include derivatives exposure. As you may know, one of the risk-based indicators used by the agencies to determine a banking organization's category under the tailoring framework is cross-jurisdictional activity. As it noted, this currently does not include derivatives exposure. The change to include derivative exposure will result in 7 foreign banking organizations and 2 U.S. intermediate holding companies of foreign banking organizations moving to Category 2 from Categories 3 and 4. The GSIB surcharge proposal also would reduce cliff effects in the GSIB surcharge by measuring GSIB surcharges in 10 basis point increments instead of the current 50 basis point increments. It would also measure on an average basis over the full year the indicators that are currently measured only as of year end. This change is intended to reduce incentives for an organization to reduce its GSIB surcharge by temporarily altering its balance sheet at the end of the year or at the end of the quarter. Well, let me touch on the transition periods for some of these requirements we've talked about. As with the prior Basel capital requirements, the proposal contemplates a phase-in period. For example, the 2013 Basel III requirements to the U.S. regulatory capital requirements included several transition periods that range from 2 to 8 years. In particular, Category 1 and Category 2 banking organizations given 4 years to phase in the inclusion of AOC in their Tier 1 capital. Further, for some instruments and exposures were permanently grandfathered from having to satisfy the requirements in the 2013 requirements. The capital proposal would become effective on July 1, 2025 in compliance with some of its requirements, such as the expanded scope of the supplementary leverage ratio may require immediate compliance. Category 3 and 4 banking organizations would be given a 3-year phase-in period to comply with the elimination of the AOC opt-out, which would end on June 30th, 2028. In the first year, they would be permitted to recognize 75% of the AOC adjustment amount, including 75% of the AOC in Tier 1 capital, stepping down to 50% in year 2, 25% in year 3, and 0% after that. All banking organizations would be given 3 years to phase in compliance with the changes in credit, market, operational, and CVA capital requirements. In the first year, they would be required to recognize 80% of the changes in the amount of the RWAs, stepping up to 85% in year 2, and 90% in year 3, and 100% in years after that. Despite these transition periods, banking organizations and their counterparties typically adjust to regulatory capital changes prior to their effective date. This is particularly true for changes to the capital requirements because capital instruments, assets, and exposures can be outstanding for decades, and banking organizations may be unwilling to accept the risk of having to increase their carrying costs at a later date. Therefore, we expect that many banking organizations will begin pricing in the effects of the capital proposal into new transactions and considering how to address existing transactions once the final rule is issued. With that, we want to thank Matt for his efforts today. We want to thank you, the listeners. If you have any questions about today's podcast or anything else related to the global financial markets, please email us at gfm@mayorbrown.com. As noted, we will have several additional programs on the capital proposal in the coming weeks. In particular, these subsequent programs will provide more details on many of the topics covered today and how these changes may affect securitization, capital markets, and fund finance transactions. Thank you all for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.